You talk to investors all the time, customers all the time. What are they asking about? What are they concerned about right now?
They're asking the questions about our two key investment themes. We have been telling clients to be overweight U.S. equities, and we've been telling them to stay invested. So after this big market rally that's been going on for so long, as you pointed out, clients are saying, are those themes still valid? Should we still be overweight U.S. equities, and should we still stay invested after this unexpectedly significant rally following 2023, which was also very strong? And our answer to both of those questions is yes. U.S. preeminence is intact, and stay invested.
So let's break that down. First of all, the equities part, then we'll get to the U.S. part. Equities, we do have real returns now in fixed income. Doesn't that shift the emphasis at least somewhat? Because you can make real money now on bonds.
Well, our view is that the upside in U.S. equities is substantially greater. So when you're looking at the return expectations, we do recommend, especially with U.S. clients, they need to look at the returns on an after-tax basis. So you can't just look at the yield, for example, on treasury bonds or on corporate bonds and then compare that to the expected return for U.S. equities. You actually need to look at both on an after-tax basis. And one of the most amazing things about U.S. equities are if you have them in some passive, tax-efficient form, you have very little bit of a tax liability, and there's much more long-term upside. So we actually recommend clients be at their duration target for their fixed income assets, but still overweight U.S. equities versus non-U.S. equities.
What about the valuation in the equity market? Because some people are concerned we're getting a pretty high valuation. So you say there's a lot of upside left in equities. Are we sure about that?
So there's no short-term upside. In fact, the U.S. equity market has exceeded our expectations for this year. So our good case for U.S. equities this year, when we published our initial outlook, was up 13%. And so now we're up about 17% year to date, roughly. And so when we look at that, we'll say, yes, it has exceeded our expectations, but earnings have been better than expected. Typically, when you start having the Fed cut interest rates, as long as we don't go into a recession, on average, U.S. equities are up 19% for the next 12 months. So we may not have much upside left for the rest of this year, but already the market's starting to think about 2025 and what earnings will be. And then as investors shift focus to 2025 and earnings and price targets, that's when you'll see some more upside.
You said something terribly important there, as long as we don't go into a recession. We had Bill Dudley, actually, with an opinion piece in Bloomberg this week, saying he's got some concerns now, growing concerns with a slowing economy, particularly with the SOM rule, that relatively complicated rule about unemployment and when it points to recession, that he says there is now a growing risk of recession and maybe the Fed should cut as early as next week. What do you think about that?
We actually follow Bill Dudley and try to talk to him often and think very highly of his opinion. He went into 2023 expecting a recession and a very high probability. So we've had this discussion with him on the likelihood of recession. We started this year with a probability of 30% for the odds of a recession, and we have stuck with that. And people say, why aren't you lower? Some people are substantially lower. We haven't changed our recession probability, partly because of the shape of the yield curve. The yield curve is significantly inverted, or it was more inverted before, and it has stayed that way. And we have what we call a yield curve diffusion index, and when that triggers, more often than not, you get a recession. That's why we're at 30%. However, when we think about these various indicators like the SOM rule that you refer to, we also have to consider and factor in some unusual situations. So people talk about the amount of immigration in the US, and so that has pushed up the unemployment rate. Or post-pandemic, we were at such low unemployment rates that getting slightly above that is not necessarily an indication of a recession around the corner. So do we worry about a recession? Do we need to be on the alert about it, look at other indicators? Yes, but are we worried about a recession anytime in the next 12 months or so? Not at this point. 30% probability. That means 70% probability of no recession.
We also have an election coming up in November, and without regard to who might win or who might lose, there appear to be somewhat different economic approaches of the two candidates. We know it's Donald Trump on the Republican side. We expect that it's going to be Kamala Harris on the Democratic side. Do clients ask about that? Are they concerned about that? Do they invest around the uncertainty with economic policy?
The biggest question our clients are asking when it comes to the election outcome, leaving aside people's political preferences, is what will happen to the fiscal deficit and the debt trajectory of the United States. That's the big concern. And our view is that while people are very concerned about debt to GDP being at 100, we also have to recognize that we got to 100, the dollar didn't tank, interest rates didn't skyrocket, the equity market didn't drop off a cliff. And so even at 100% debt to GDP, investor confidence is that that is a sustainable level. The question is, where is the tipping point? And the reality is nobody knows where the tipping point is. We've asked different people, different economists, people you have on your show on a regular basis, do we actually have any insights? And the reality is we don't. The IMF has done a study where they think debt to GDP in the US is on a level that gives us some fiscal space, is about 180. University of Pennsylvania, Wharton, they've done their own modeling. They're at about, the average is around 180% debt to GDP. So right now we're at 100. So there's definitely some fiscal space. And so will either president winning, and whether we have a Democratic sweep, a Republican sweep, divided government, they'll make some difference at the margin, but not enough to derail our U.S. preeminence theme. And that's what we tell clients.
And so in a nutshell, as you see it right now, that problem, that fiscal problem, is not on the immediate horizon. It may be somewhere out there, but not right now.
Not immediate. We definitely couldn't sustain these levels for a while. Again, because of U.S. preeminence, reserve currency status, incredible earnings per share growth, so portfolio flows as well as foreign direct investment.